Today, guys, we're going to talk about the first M of multifamily. And guys, just for fun, I'll run through them real quick. The first M that we're going to talk about today is market, right? You guys need to pick a market, and we're going to talk about why that is, what we're going to talk about in other webinars, because we're going to do some deep dives on these other concepts as we continue to put these free, capital F, free webinars out for you guys to learn from us. The other M's are money. Those are all the guests. That's true. You need the money, you need that clackety-clackety, but you got to do these things in order, right?
That's right.
You should not be out getting yourself in money conversations until you've chosen a market. One of our students, Hari and Amy here, phenomenal students, absolutely crushing it, building out some really great stuff. But we worked with them in our accelerator program on picking the market of Kansas City and drilling in, building the relationships there first. That's the first thing they did. Now they've got their money machine going. And I tell you what, that money machine, Hervé, that they built is humming along, man. It is a well-oiled machine in that. The next M is start making offers. They're graduating to that too. You got to make offers. You can't say, oh, that deal's overpriced, right, Hervé? Make the offer, right?
That's right.
We'll do deep dive on that in a later webinar. The next thing is make a match. You might be operating by yourself, and we find that at DeRosa, the way that we are successful is because I run my side of the company, Hervé runs his side of the company, and Justin is the leader of his side of the company. And through making matches like that and finding people with core strengths, that's the way you're going to grow. And the last one is you got to have a mentor. You got to have somebody who's been down the road further than you. Can't wait for that webinar because I can talk to you guys about some of the mentorships that I've gotten over the years. I'm sure Hervé's gotten plenty of mentorships through 28 years or 23 years of Wall Street. So we can share personally about mentorship relationships that we've had, and also, of course, what we can offer you guys too. So let's hop back in. Hervé, pick a market. Why can't I, Hervé, just go on LoopNet? That's what I'm going to do. I'm not going to listen to DeRosa Group. I'm going to go on LoopNet. I'm going to put a filter on there that just tells me any multifamily asset in the United States that's selling at above a 8% cap rate. Why don't I just do that? Because that'd be a great deal, right? I could do that, and I should be able to find great opportunities. Well, why should I not just do that? Forget the market.
That's going completely backwards. Okay, yes. You do not want to start on LoopNet on trying to identify an attractive market to buy. Listen, LoopNet can have some really attractive deals on their website. There's no doubt about it. I am not sitting here going to talk about the level of quality or poor quality of the deals on LoopNet. But I will tell you that you can buy what you think is an attractive property on LoopNet in a very, very bad market. Which is why the number one thing you need to do is pick the right market. Because I'll tell you right now, and that will agree as well as everyone else on our team, you cannot manage yourself out of a bad market. You would have bought that property out of LoopNet. You would have got it at a great price. You put some great cheap debt on it, maybe even assumable debt. It's the unit count that you want, and so on and so forth. And all of a sudden, it's in a terrible market that is experiencing all kinds of declines against all these metrics we're about to talk about. So you do not want to start with LoopNet. You want to start with picking a market. That market could be right in your backyard because you feel comfortable with it, as well as there are some good trends in that market of your own backyard. If it's not in your own backyard, it could be the market next door. It could be the market in the state next door. There's no doubt about it. As long as those metrics play out for you.
A bad market will make a good deal a bad deal in that. So that I could tell you guys some battle stories, deals that were great deals, looked phenomenal in Trenton, New Jersey. But the lovely town of Trenton, New Jersey that I used to own quite a bit of real estate in happily blew apart all the deals that I had, a lot of the deals that I had there, because you can't fix a bad market, and you can't control a bad market. The market is way larger than you are as an operator. So the market's going to pull you in the direction the market's going. So that's why picking a market is super important. And also just to highlight, guys, as you guys do more and more deals in a market, like for Hari and Amy in Kansas City, they're going to do lots of deals there. They can leverage better relationships with property managers, contractors. Real estate brokers are going to take them more and more seriously as you do more and more deals in a market. You're going to get just that many more leads for deals. So, Hervé, when picking a market, there are metrics, there are parameters. You can't just pick a market because you like the name. You can't pick a market because maybe if it's close to your house, I get that. But market selection, there are parameters. So you have developed a few core factors for markets. The first one is population growth. Maybe goes without saying, but why is this the first one, and why does this matter?
Yeah, I would say tied to population growth, this one and the size of population also matters, right? And the main reason why is, number one, we want to make sure that we have a good number of residents that are going to be filtering in and out of our properties, on an annual basis as leases come up and so on and so forth, right? These residents, they are going to be themselves many times choosing a market in which has good job growth, a good job market, it has good schools, low crimes, and so on and so forth. When you think about a person's wish list, that wish list can certainly be your wish list as well. So when we look at markets and population size alone, we tend to look at markets that have a population size of at least 100,000. And whatnot. And if it doesn't have a population size of 100,000, at least it is within the proximity of a major metro obviously that's going to have a very large population. And this smaller town may be just a commuter town to this larger metro. It's where folks live in the suburbs, but they commute into the city for work, for school, and so on and so forth. That's population side. Population growth. We want population growth because we want to make sure that the market that we chose is a market that's not in on its way to becoming a ghost town, right? Yeah. Because people are moving out, they are migrating out. We could keep hearing that word migration over and over the past several years. People from the Northeast migrating down south, people from the Northwest migrating down south, and so on and so forth. Now you got some migration taking place into the Midwest. So population growth, you want to make sure that you understand that there is a reason behind people moving into a market as well.
Absolutely, right? You don't, is the whole thing that I said before, you don't want to hitch your wagon to a declining market because you can't fix that. You can't, you as a landlord cannot make people move to the market. If people are moving to the market, they're going to need a place to live and you can provide that to them, but you can't fix a declining market. Next one, Hervé, median income. Right. And I want to clarify one thing. When it's median, because people have asked this question, when you look at median income data, are you looking at individual median income or are you looking at a family's median income, meaning like husband and wife, if they're both earning? What matters more, how much the individual makes or how much they make as a collective, and why?
Yeah, it's a great question. And a lot of times I'm looking at the husband and wife. I'm looking at the family median income, right? Because, this is it's going to be telling again of the job market. It's going to be telling of, whether partners, spouses living together, how much collectively they are making, because that is going to be able to tell you the spending power that they have collectively to go ahead and afford the rents that you're going to be posting on your apartment. So median income is very, very important. And Matt, as you know, right, you were the landlord for many, many years before you got in large multifamily. When you start doing financial background checks on your residents, one of the things that you use as a rule of thumb is that they have a median income, there you go, right, at three times the monthly rent, right? So you take
let's say it one more time. Everybody get out your pen, write that down for those of you guys that are rising landlords and are not using that rule right now, right? Hervé, one more time. 3 times the rent.
The monthly rent, exactly, right? So that's what you want to do. So what I usually do to make the math easy for me, I do go 3 times 12, which is 36. Right. So I go ahead and I take that rent number. So if the rent number, just for easy math, is $1,000 a month in that particular market, then I want my tenant, my resident, to be making a minimum of $36,000 a year in income.
Yep.
Right. So of course I would want them to be making more than that because I don't want them spending 100% of their income on their rents.
And the way to look at this, guys, is that let's say Hervé's evaluating a market, median income is 50K, right? The median family income is 50K. What that means to Hervé is that if a deal that we're looking at has a rent target, or you're going to build a brand new apartment building, new construction, and to overcome the cost of new construction and achieve a profit margin, you got to charge $1,800 in monthly rent on a unit. Do the math, guys. That does not work out very well for a market where the median income, a family income is 50K, right? That means that the average resident of that city cannot afford to live in your apartment building. They wouldn't qualify, right? You want way more than the average. You want the median. You don't want to squeak through either, right? Like as Hervé said, like if your rent is $1,000, you don't want to see a median income of 36K, right? That means okay, the average person can live there. You know what that really means, Hervé? That means half the residents of that town can't afford to live there.
That's right. That's right.
That means half of them can't. The other half can. But I would want to see almost like double that. I'd want to see a median income. If I'm doing a deal where the rent I'm going to be charging is $1,000, I want to see a median income of $75,000. That means that 3/4, 75% of the population of that town can afford to live in my apartment building. Now that means my apartment building is going to never have a affordability or a occupancy issue because most people can afford to live there. And if I make it a really cool, nice space that people want to live in, I'm not going to have an occupancy issue. Right.
All goes back to your bottom line, guys. Listen, one of the things you also want to take into consideration, right, is also the type of property that you are purchasing in a particular market, right? Class A versus Class C, right? We know that the Class A type properties, those built within the past few years with all the bells and whistles, they're going to be able to command a higher rent in that market versus a Class C, property built in the 70s or 80s or something like that. So that's something that you have to take into consideration, particularly if your focus is going to be on Class A. You're going to need the median income of your residents to be even higher than average, if you will, because you're going to be some of the highest rents in that particular market, which is going to need to justify higher income from the residents of.
And one more tip here. Our friends at Bright Investor have sub-market data. So it's fun to look at, like say the market rent, the average rent or the average median income for an entire city, but it's more poignant and more beneficial for you to look at the rent in a certain neighborhood, a zip code. And that data exists. Bright Investor has that data. So you could look at the median income within within the zip code or within like a, couple hundred, like a 1 mile radius of the apartment building you're looking to buy. So it matters, yes, what the median income for the city is, but more importantly, what a median income for the neighborhood around the property you're buying is. Because the people that want to live in that neighborhood, make sure your apartment building can be afforded by the majority of people that are in that neighborhood too.
Yep.
Hervé, job growth, not just jobs, not just money coming in. I want to see growth. Why?
Well, listen, you want to see job growth, right? Because besides, folks, residents moving into the market, many times that is predicated about the companies moving into that same market, or the companies that are already in that market, expanding their manufacturing facilities, hospital wings, student enrollment increases at the local universities, and so on and so forth, right? So that is going to go ahead and be a magnet, if you will, for folks, right? Where there are jobs, there's the growth and whatnot. Trust me when I tell you, the bigger companies, they do a lot of research before deciding exactly where they're going to put that next factory, that next facility, that next industrial development center. Of course, Amazon coming in with its distribution center or fulfillment center and so on, with the expansion of airports and things like that. We keep on hearing about one in Northern Kentucky where Amazon is going to be building a huge hub, and that's where they're going to be doing all their shipping for one-day deliveries and so on and so forth, right? So when you start doing background research on markets, you take a look at the Chamber of Commerce sites of some of these particular markets and things like that. You take a look at the local newspapers, you start seeing about groundbreaking and so on and so forth. Those are all the taglines. Those are all some of those trigger words, if you will, that's going to give you that indication, that's going to give you some insight that, hey, this is an area that is attracting companies, that is attracting job growth and whatnot. And it's so incredibly important. If you don't think it's important, think about, and we all know, unfortunately, of cities around this country that have been completely decimated because of job exports, right? That they've left that city and they've gone someplace else and whatnot. And so we see that's definitely, Matt, talk about Trenton, New Jersey. I mean, that's a classic example of both, right?
And that's probably, Hervé, the metrics that I should have looked at when I first decided. I had not met the Matt Faircloth in the future to teach Matt Faircloth in the past. But if Matt Faircloth today were to talk to Matt Faircloth in 2005, I would say, well, what are the job opportunities in Trenton? Aside from the fact that you can buy a property for cheap and rent it for a lot, and obviously you got to find the right people to live there, and the people that live there have to have a good job that affords to pay the rent that's there, right? There's a lot more factors to it. Trenton didn't have this factor right here. There's no real employment centers in the city, and there's no major industries or even mid-sized industries that are growing in that town. And that's what, if that were to change in Trenton, and when that does change in Trenton, you will see a different city rise. But until then, it's going to be what it is, and that's why Trenton still looks today like it did when I started investing there 20 years ago, because of this factor right here.
That's right. That's right.
All right. Here's another one that this is maybe a derivative of. You and I could get into a debate, Hervé, on whether crime and job growth are linked. But Trenton, because it does not have a major job magnet there, maybe that's a factor. But Trenton also has a major crime issue. Not to keep picking on Trenton, and other cities do too. But Hervé, of course, I mean, maybe goes without saying, but touch on this briefly. Why is crime a factor? Why should people consider it in a city and in neighborhoods and whatnot? And then maybe you want to touch on real quick, where do you get the data?
Well, listen, it kind of goes without saying, right, that, folks don't like to live in an area, to live in a market that is just, overwhelmed, swarmed by crime and whatnot. Folks are going to be unsafe. This is a market, this is an area that they're going to be, having their families, raising their kids, and so on and so forth. They want to make sure that their kids are safe. They want to make sure their family members are safe, and things like that. So listen, not only the individuals, but the companies as well, right? Companies don't want to go ahead and start investing in cities that are infiltrated with crime. Unfortunately, we're hearing a lot of, sad stories about companies moving out of cities because some cities are just overwhelmed by crime and things like that. Now, what happens is, money has a lot to do with this. Taxes have a lot to do with this. But when we start talking about classic urban decay, classic job decay, as the jobs move out, peoples move out, less property taxes coming from the businesses, less property taxes coming from the individuals, not enough to pay for the protection of people, police, fire, EMS, and so on and so forth. And with a dearth of those type of services, you typically see crime rates start to go up and whatnot.
Absolutely.
Right? You just want to be cognizant of it. I won't go too deep into it. As we know, there are different levels of crime. It's something that we take into consideration when we are looking at markets ourselves to go ahead and invest. And we do bifurcate murder versus, let's say, auto theft. Not poo-pooing auto
This is
theft.
more of a neighborhood thing, guys,
right?
not for a city, but but if you're looking at the neighborhood, well, let's go there. If you're looking at the neighborhood, if you see, for us, if you see aggressive crime like that, like, murder, assault, that kind of stuff, that's one thing. And also drug activity. Those are two things that we tend to steer clear of. If you see, as Hervé said, car theft or, those kinds of things,
Vandalism,
not that it doesn't matter, but that's
it does matter.
way, like, miles less of a factor than
Right.
things like drug activity, which for me is a non-starter, because that can be really, that can infiltrate a whole neighborhood, and there's nothing you can do. Take it from somebody who knows. Take her from somebody who knows, and former landlord up from T-Town. That is something that you cannot remove. It is something that's an infestation it's hard to get out of your properties and whatnot. If that exists, I would probably steer clear. So moving on. All right, Hervé, lots of acronyms. I'm not smart enough for these words. What does this mean? What are we talking about here?
Well,
CPI,
these aren't too challenging. CPI, Consumer Price Index, right? Just the amount measure of inflation, and then of course real GDP, gross domestic product, in regards to measurement of the economic growth of a particular city, market, neighborhood, not necessarily neighborhood, excuse me, state, and so on and so forth. So we look at these. Obviously, these are real more moving targets than anything else. I mean, unless you are in a market that is extremely small, really off the beaten track, a lot of the metrics here will measure the state figures on average and whatnot. So it's something that we look at, but it's not a huge determining factor for us on whether or not we're going to go through and pick that particular market and whatnot. If it's an outlier, the CPI or the real GP, one way or another, if it's an outlier relative to how it measures within the overall state, we might go ahead and do a little bit more digging, right? That the one that we would be concerned about is if the CPI is an outlier well above the state average, and if the real GDP is as an outlier well below state average as well.
And guys, a few questions coming in. Stay tuned, guys. I have the answer to that question, but I'm going to leave you hanging for a second here, because we've got the answer to that question, but I want to get through the other factors, and then we'll talk about where to get all this stuff from. Hervé, man, that guy looks sad. I feel unemployment rate, right?
Yeah.
Right. Unemployment rate. Maybe goes without saying, but touch on this real quick, why it matters, and when you're evaluating a market, why is this a factor?
Matt, this dude looks like a dude I used to work with that got fired during the technical burst.
You took the picture of yourself walking out of that. I was walking
I was like, hey, bro, man. I think he used to work at Lehman Brothers or something like that.
Yes.
Man.
Hervé was around. If you guys want to hear a crazy story, ask Hervé to talk about the day that Lehman Brothers fell apart, because Hervé was working on Wall Street that day. Hervé was standing when that went down, when he saw people walking out of Lehman Brothers building with boxes. That guy walking out of Lehman Brothers building right there,
What the
I started to laugh about it, but I mean,
I know it is not.
Hervé will chill you to the bones about stories that he saw on Wall Street. So.
Well, listen, the unemployment rate, obviously, again, kind of goes without saying, but another metric, you can tie that into CPI, real GDP, and everything else like that, right? So if the real GDP is falling in a particular market, you're going to expect the unemployment rate is going to go ahead and pick up and whatnot. Listen, luckily for us across the country, unemployment rate is pretty low. I think we're at 3.7%, might be a little bit lower than that. So 3.5 to 3.7% nationwide unemployment rate. So a lot of markets right now, they're they're going to be around that average. Some cities, believe it or not, 2.5% unemployment rate, which is pretty much full employment, if you will, and so on and so forth. It may not feel like that. We see all kind of job openings on Indeed.com and things like that. That never made sense to me. But at the end of the day, unemployment rate, we like to see that low, and that's going to be direct sympathy of how the job growth is going on in that particular market.
Absolutely. It's a real thing, guys, real factor. You got to know how stable the companies are. Unemployment rate is obviously a bad thing for tenants that you have that may get laid off, but it also is a bad thing for the source of the income that those tenants are using to pay their rent. And if those companies that are in that market are not stable, that they can't employ the workforce of that city, that is a factor for you to consider. Diversity of jobs. And Hervé, you referred to this earlier, meaning like you want to work in a city where you can't have an industry go under and end up, laying off half the town, or an industry going soft and laying off half a town. What are some metrics that you like around this, or just touch on job diversity in general that you like to see here?
Yeah, listen, I don't like to see any one industry represent 20% of a market's particular economy. That's going to concern me, because that means that God forbid, if that particular industry winds up taking an economic hit, be it jobs are leaving, there's shrinkage, there's consolidation going on in the industry, and so on and so forth, right? Then it's going to cause a lot of fraction within that particular industry. Jobs are going to go away, they're going to decline, and so on and so forth. And as that happens, right, the city winds up going to decay. You think about Detroit in the 1990s, right? Perfect example. Heavily tied to the auto industry, a lot of jobs leave, wind up going down south, and the next thing you know, Detroit winds up going into its own recession, more so than the rest of the economy, the rest of the country, the rest of the state of Michigan, and so on and so forth. So that's why we stay away from markets that are heavily tied to one or two industries driving that economy. You can have a lot of fun in those markets, the Orlandos and Vegases of the world, a lot of great times, beautiful times. Yeah. How, when it comes from an investment perspective, listen, what we're all talking about, all these metrics here, is you are hedging yourself as you are picking these markets, knowing that real estate is a lot of fun, but at times it can be challenging with its economic cycles. Boom, we get hit by a pandemic. Boom, we get hit with geopolitical issues, and so on and so forth. So how do you soften those blows that you did not forecast in your underwriting? Is that you do these steps in going ahead and picking your market, so you're not caught off guard if all of a sudden we slip into a recession, and because of that, folks aren't going to be gambling in Vegas as much. And so next, you see the, economic trends in Vegas start to turn down, and so on and so forth, right? So there's that. And then there's, okay, hey, if I have a magic wand on what kind of makeup I would like to see of industries that drive an economy, first and foremost, I'm going to pick healthcare, because healthcare pretty much recession resistant, right? Yep. Need the healthcare in good times and bad times. I'm going to pick healthcare. I'm going to pick retail. I'm going to pick manufacturing. I'm going to be picking tech. And I certainly like education as well. Cities, markets with universities, decent size student enrollment, and then, of course, the professors there and the other employment there at the university.
Eds and meds, right? Eds and meds.
Eds and meds, no doubt.
All right, guys. So those of you guys, here's one of the, there's just a little giveaways we're going to give here. Some of you guys may already have this, but those of you guys that don't, go ahead and scan that QR code right there. And while you guys are grabbing that, Hervé and I are going to pivot here and jump into analyzing a very specific market that you guys may have heard of or whatever. But while you guys grab that site is that spreadsheet that Hervé made. That is his market analysis tool. All the data that he talked about is in this tool, and where to get the data that he just talked about is in that tool as well. This is a scoring sheet. You guys give the metric score for that market, add it all up. There's instructions on how to use it below. If the market ranks a 41 to 70 in total points in the score that you give the market, it's a marginal market. We like markets that score between 70 to 100. And obviously, if it's below 41, not a market you should be considering. And so, guys, use this market tool right now. And there's clickable links there in the sheet on where to get the data.